Exchange-traded funds, or ETFs, are an excellent method for investing for high returns. In this video, you will learn about 3 strong ETFs and the factors you need to consider when deciding which ETFs to invest in. Make sure you watch this video to the end before you invest your money so you can make the best investing decisions. We want to maximize our returns while minimizing risk, cost, and wasted time. As I show you these 3 top ETFs and what makes them a good investment, I'll explain 7 things to look for in an ETF. Not only do I want you to understand why these are good ETFs to own, I want you to be able to do your own research and understand whether to invest in ETFs based on your own research and knowledge. The 3 ETFs we will talk about today are INVESCO QQQ TRUST SERIES 1, or QQQ, VANGUARD S&P 500, or VAU, and ISHARES CORE DIVIDEND GROWTH, or DGRO. The first thing we will look at is performance. We want to know how well the ETF performed in the past. Did it make money? Did it make a lot of money? Did it lose money? People will tell you that past performance does not guarantee future performance, and it doesn't. But if you are choosing between an ETF that lost money for the last 15 years or made money for the last 15 years, which do you prefer? Since the inception of QQQ in 1999, it has returned 7.27% with dividends reinvested. $10,000 invested in 1999 would now be worth almost $44,000. Since the inception of VAU in 2010, it has returned 11.71% per year, and $10,000 would now be worth almost $29,000 with dividends reinvested. Since inception in 2014, DGRO has returned 9%, and $10,000 with reinvested dividends would now be worth around $16,600. Let's compare these ETFs for a moment. Based on PortfolioVisualizer.com, since 2014, when DGRO began trading, QQQ has returned 13.42% annually, DGRO has returned 6.53%, and VAU has returned 6.56%. These numbers do not include reinvested dividends. When considering an ETF, look at the past performance and compare the ETFs to one another to get a sense of what sort of gains you could have had if you had invested in the past. If the ETF you are looking at has not been beating VAU, DGRO, or QQQ, why? And do you still want to invest in it instead of one of these 3? Second, we look at fees. ETFs will have management fees. You are paying a company to manage your investments for you, and they will take a percentage of your investments every year. In addition, depending on the ETF and the broker or investment service provider you are investing through, you may have to pay a commission on each purchase or sale of an ETF. Some companies will allow you to do this for free, whereas the commissions of others can add up quickly. The average expense ratio for actively managed mutual funds is between 0.5% and 1%. They rarely exceed 2.5%. For passive ETFs, the typical ratio is about 0.2%. DGRO has a net expense ratio of 0.08%. If you invest $1,000, you will pay 80 cents per year. VAU's expense ratio is 0.03%, meaning you would only pay 30 cents on a $1,000 investment. QQQ is at 0.2%. Although this is higher than the other 2 ETFs, it is generally in line with fees charged by passively managed ETFs. If you're getting any value from this video, please take a moment to like it, and if you have a specific ETF you would like a video analysis of, let me know in the comments below. Third, we want to know, what is the underlying index or strategy of the ETF? Every ETF is designed to track an index, follow a strategy, or serve a specific purpose. As an example, VAU is an index fund which tracks the S&P 500. If you are unfamiliar with index funds, watch the video linked at the top of the screen for a detailed explanation. If you're interested in broad diversification across large US companies, VAU is intended to meet your goals. Take a look at Fidelity.com's data. If you buy a single share of VAU, you will automatically own a piece of companies like Microsoft, Apple, Amazon, Facebook, Johnson & Johnson, and Google. Almost all of your investments will be in large companies, in the United States, in information technology and healthcare, with significant allocation to communication services, financials, and consumer discretionary. What about QQQ? It is a passively managed ETF with a benchmark index of the NASDAQ 100 index. In other words, it tracks the 100 biggest companies on the NASDAQ. What sorts of companies are we talking about? Big tech. In fact, 46% is in information technology and 20% is in communication technology. The vast majority are large companies in the US. Unlike VAU, which had more of a focus blending between value and growth, QQQ is focused more exclusively on growth. DGRO is a dividend-weighted ETF with a benchmark index of the Morningstar US Dividend Growth Index. What is this index? Morningstar states it is to provide exposure to US-based securities with a history of uninterrupted dividend growth. Companies are included in this ETF only if 1. They pay a qualified dividend, 2. Have 5 years of uninterrupted annual dividend growth, and 3. Have a significant margin to continue growing dividends. Their top holdings include Johnson & Johnson, Verizon, Chevron, Pfizer, JP Morgan, and Procter & Gamble, in addition to major tech companies. It has greater diversification across sectors, as we can see information technology only makes up under 19%, and 5 sectors are in the double digits. It is primarily focused on the United States and large cap like the other two, but does have over 9% in mid-cap companies. A big difference we see here is the focus on value rather than growth. Because of this focus on dividends and value companies, the trailing 12-month distribution yield for distributions or payments to shareholders was almost 3%. VU was at 2.24% and QQQ was at only 0.85%. What strategy or index you are looking to invest in will dictate the ETFs you will want to invest in. Number 4, we look at analyst ratings. Now, ultimately, you want to do your own research, but looking at how analysts are rating the ETFs can give us useful information and alert us to red flags. I will do a future video on how these analysts calculate these ratings. FactSet gave DGRO an A rating. Morningstar gave it 5 stars. Ned Davis Research Group rated it 3.6 out of 5, and XTF Incorporated rated it 9.7 out of 10. These are all high. QQQ also gets an A and 5 stars. It has a slightly higher 4 out of 5 from Ned Davis and a slightly higher 9.8 out of 10 from XTF. VU has an A, 4 stars, a 3.5, and a 9.9. In other words, all 3 ETFs are highly rated across a range of analysts and methods of rating. Number 5, we look at the size and trading activity. Why does this matter? Because if it is a small ETF with very few investors or investing activity, it can be much harder to buy or sell shares of the ETF. If you want to sell, but no one is interested in buying, you will be unable to sell, have to wait longer than you expected to sell, or get less in return than you expected. At the time of this video, DGRO was managing $9 billion in net assets and had an average trading volume of almost 3 million shares. QQQ managed $95 billion with an average trading volume of 54 million shares. VU had $129 billion of net assets with an average trading volume of 6.7 million shares. In fact, at the time that this video was created, VU was the 3rd largest and QQQ was the 6th largest ETF by asset value in the world. DGRO was 88th. QQQ's trading volume was 3rd largest in the world. Given that there were approximately 1,750 ETFs based just in the US at the time of this video, you know that these 3 are massive. Number 6, another consideration is duration. The longer an ETF has existed, the more history we have to analyze. We'll have more information about performance, ratings, management, and what to expect. We also know if an ETF was around prior to last recession and survived, how it performed during a recession, and that it had some staying power. Not all ETFs survive. An ETF that has been around 10 years may give us more confidence than one that has only been around for 10 months. Number 7, and last, we want to consider tracking error. What is tracking error? ETFs are designed to track indices. If an index is up 15%, a fund should be up 15% too. Unfortunately, that is often not the case. Fees, transaction costs, poor fund management, or only sampling an index can give you results which do not match the index the ETF was intended to match. Let's look at the tracking of our 3. Over the past 5 years, the S&P 500 is up exactly 33.13%. VU is up 33.28%. Over the past 5 years, QQQ is up 92.53%. The NASDAQ 100, which it tracks, is up 92.52%. DGRO is up 31.53%, and its index, the Morningstar US Dividend Growth Index, is up 30.68%. We can see these ETFs are doing a good job of tracking the indices. This video has been on ETFs for large US common stocks, but you may want diversification outside of this asset class. Make sure you subscribe to this channel because I'll be creating new videos for you every single week, and I have one coming soon on bond and real estate ETFs. As always, good luck with your investing.